sitting down with Price Headley, president of Big Trends. Thanks so much, Price. Good to sit down with you.
It's great to see you, David.
And we've known each other for a while. I haven't seen you in such a long time. It's so good to see a friendly face from the Midwest.
It's a pleasure. Yeah, I'm in Kentucky, but as long as you got a good internet connection, you can be anywhere, right?
That's right. That's exactly right.
Yeah.
So for people that aren't really familiar with you and your background, can you just give us the quick version? How did you get to this point? What were the formative moments that sort of led you to where you're at now?
Well, it started for me, I'm from Kentucky and my family's been in the thoroughbred horse business for generations.
No kidding.
So when I was at Duke University and was hating doing the pre-vet, trying to be an equine veterinarian, I was like, hey, let me get into this trading contest, and I did really well at it over 4 months. My grades went down and my portfolio, my paper portfolio at the time went up. But I was like, Dad, I'm switching majors. I want to do something less risky than breeding thoroughbred horses. I'm going to trade stocks and options. He thought I was nuts. He's like, as long as you stay on the 4-year plan, we're okay. And I did, and so that was a turning point for me of like really finding my passion for what I wanted to do in terms of the trading and just that active. And that was the late '80s, so it was still that kind of post '87 crash, but takeover talk was always abounding, and so it was really an interesting time to start to learn way before the internet. Then got into an options newsletter that I started working at after I graduated from Duke, and then kind of built my way up there, and then started Big Trends back in '99. We're actually on our full 20-year anniversary this coming week.
That's
so
awesome.
Yeah, it's been an exciting last 2 decades with all the volatility and all the changes and trends.
It's a heck of a stretch to be doing that for.
Yeah, so we've been very blessed.
Yeah, 20 years is impressive. Can you talk a little bit about the technical side of your process? Where, how were you introduced to technical analysis, and how did you sort of learn the tool? How did you develop your toolkit over time?
Yeah, I would say that, my original bent was to come at it from more of a fundamental perspective, and I made some of those classic early mistakes where I thought that my fundamental analysis was right and that the market would figure it out and catch up to my, of course, such great analysis, which didn't happen. And so you make enough of those mistakes that early on, and I guess to me that's a blessing of especially going from an investor side into a more active trading role, especially with options. You can't just buy and hold an option, especially when you're in this sort of conversion. You have to be right more quickly, and you want to be right more quickly regardless of what you do. So I learned that the technical analysis side really got me more in tune with not just the short term, but where the money was flowing in or out of a stock. And so, and you could see that with charts. And then I started to use platforms where I could actually start to code my theories and say, okay, did this work over decades of past data or not? And most of the great ideas I had didn't work over decades of data, and you had to weed through 95% of those to find the best of the best ideas and then start putting those to work. So it really gave me a way to kind of fast forward with the technology back in the DOS prompt days before we were into all this great technology that's available now on your all's platform and so many out there. It's just phenomenal what we now have at our fingertips. So back then it was literally kind of just ones and zeros kind of grinding.
World,
yes, exactly.
So I found a lot of investors, it seems they're a little frightened of the options market because there's sort of this knowledge gap. It's sort of a hurdle to kind of get past. How do you make it accessible for people just getting started in option? How should they think about options trading versus other forms?
Yeah, I tend to think of it as like when you want to build a bridge between going from stocks to options, you want to think more like, how can I substitute for the stock and not try to get 10 times as many contracts and 10 times as many shares out. If you would have had 100 shares, don't try to take that money and turn it into 1,000 or 2,000 shares. Figure out how can I replace that 100 shares with one option contract, control that same 100 shares. And so the first strategy I tend to recommend is more of a stock substitute. So if the stock's at $100, go buy the in the money 95 call or even 90 call. You're going to pay more for that option, but it's still probably pay maybe 15% of what you pay for the stock. Get some reasonable leverage, but not off the charts leverage, and kind of go in that way, tiptoeing into the pool rather than just splashing into the deep end and then swearing off options forever because you bought the wrong option in the first place, right? Most people get attracted to the really cheap options that are way out of the money, have a very low probability of being successful, and then they go, well, that's a terrible game, I'll never do that again, or they heard somebody that made that mistake. So it's much more sensible to kind of start slow and build gradually and really put a focus on the front end on education so that you don't try to say, I've got to hit a home run on my first trade, but rather like, how do I educate myself about what are the right strategies to use, whether you're a growth investor, an income investor, or some combination.
Yeah. So you mentioned just education. Can you talk a little bit about Big Trends? What are you trying to accomplish there? What's your approach with the website? With the firm?
So we really have two pieces with Big Trends. One is more of a do-it-yourselfer piece that's about digital education, coaching, a trading room where people can look over my shoulder 1 hour a week just to kind of see, validate that they're on the right track with what I teach in terms of how to follow a trend and stay with the trend. Because most people have really, I call it, have developed so much scar tissue from their mistakes in investing and trading that they're doing all the wrong things. They're taking their gains way too quickly, they're holding on to their losers too long, and they're almost guaranteeing themselves trouble versus saying, okay, if you're right, you want to keep milking that idea and then have a plan to keep trailing your stop and get the most out of your good ideas and then get rid of your bad ideas quickly, especially because we just had this huge breakthrough for option traders, which is that brokers have gone to no commissions or at least no ticket charges. So you got tiny costs compared to what it was, so you can be more active, you can be more proactive in how you trail that. If you get stopped out of something, you go right back in and not worry about those kind of commission costs eating you up like you used to. So a lot more opportunity to adjust your position, manage it, and not feel like you're killing yourself on fees.
Part of this general theme of making the markets more accessible, more democratized.
Exactly. And so then the other piece we have is we do specific trading alerts for subscriber groups that want an income strategy with credit spreads or want a growth strategy, looking for whether it's the conservative growth or the more aggressive home run type of growth, and say, okay, there's something in there for everybody, and we have a number of clients that have a portfolio of both growth and income products that way.
Very good. So you seem relatively warmed up now. I'll ask you the maybe painful question, which is a worst call, right? Can you give an example, think through your history, a call that went against you or a trade that just went against you? Dealing with loss is something I think a lot of people struggle with. How did you sort of deal with that experience? What did you learn from it? How did you get through it?
Yeah, well, I'd say, again, on that front end of when I first, when you come from a really strong educational background, I was blessed to have, with Duke and a lot of other great education along the way, that whole process, and even through most everybody's careers, it's about you get rewarded for being right. You get rewarded for you're on the right side of something. You got into a winning project, a profitable project. If you're in a losing project, you probably didn't get promoted. Same thing with the education system. Get that A+, and you're going to go to the highest level. Well, you take that into trading, and you say that leads to. I had just massive perfectionism on the front end when I got started trading, because I'm like, well, of course I want to be perfect, doesn't everybody? But that's not the secret to making the most money in trading and investing, because the secret is get rid of your losers quicker, hold on to your winners longer, and most people are doing the exact opposite, as I mentioned. So it's a big shift, and so I'd had a couple of just blowouts early on with my own money, thankfully, and nobody else's, where I was just like, okay, I know this gold stock's going to go through the moon, we're going to have inflation, market's going to wake up to this, and it's going to be up huge, and then I'm going to just totally cash in 20 times on an out-of-the-money gold call. That, of course, what had happened, it blew up to nothing. Same thing with another tech stock that I thought was a sure thing that wasn't. So you and the more you think it's a sure thing, let's face it, nothing is a sure thing in investing and trading. You're playing a probability game, and if you don't know what your edge is, you probably shouldn't be trading until you figure out what that edge is. So we're constantly training people like, this is your edge. It works 65% of the time. When you're wrong, you're going to lose this. When you're right, you're going to make 2x or 3x or whatever. So, and even if you do credit spreads, you're like, I'm right 80% plus of the time. It's that 20% that'll blow you up. So it's like knowing how to manage the trades that are not your friend is just as important as how to manage the trades that are working for you. So, but that was a real eye-opener. That's where the technical analysis really took over for me, because then I'm like, okay, I want to be in tune with what the charts are saying. I don't want to try to be ahead. I don't want to try to be bottom fishing on something that's been a dog and I'm betting it's miraculously going to all of a sudden have a big upside pop. A lot of people do that and wonder why they're not successful. And it's like, maybe in stocks you can wait, time is your friend if the stock is going to eventually make that pop. But if it takes you way too long on your option, it's not going to work. So most people have gone towards selling premium because they think, well, buying options doesn't work because it takes too long for that to hit. And then they sell premium, and then we're at very low volatility levels. The VIX is at under 13, the CBOE volatility index, so you can chart that on your platform and see, okay, when it's this low, it's probably going to pop. And so it's like, I don't really want to sell those cheap options either. So it's about knowing when to, every strategy has a pro and a con, and knowing when to use a buying strategy or a selling strategy or some kind of hybrid. It's all about timing.
That's great. It's a perfect example of where technical analysis can add some value to it. You strike me, I don't know if you remember, the first time we met was actually, I think, down in Florida.
So Market Technicians?
It was at Market Technicians Association conference. We had dinner together. I sat with you And what I remember particularly is that you smile a lot. So can you talk a little bit about how you stay positive in an environment which is actually really challenged, it's stressful at times to be trading, especially options. How do you kind of stay centered through that? How do you deal with the periods of adversity?
Well, I think part of it is capital allocation. Like, you know that you're never going to overcommit on any one trade. I don't care how much you love it. If you think it's the greatest slam dunk home run, I don't care. I will not exceed my position maximums ever.
Yep.
So, and then I'm spread out across 10 different portfolios, so it's one of those things where no one trade can make or break me. So it makes you a lot more centered, even amid a volatile potential vehicle like options, to say, okay, it's more about taking those edges out over a long period of time and not worrying about what's going to happen today, tomorrow, the next day, if you follow your rules. And that's where most people don't have the template or the discipline to say, okay, I know I'm going to follow this rule. Today might have been a losing day, but if you follow, I always tell my analysts and my team, if you follow your rules and you had a losing day, that's a check plus. If you made money and you didn't follow your rules, that's a check minus. You can get fired for making money and not following your rules if you do that often enough. So because it breeds a lack of discipline. It leads you into problem territory.
Right.
So it's a lot of this game is about taking your ego and getting your ego to the sidelines. And saying, okay, because when you go back to like the mistakes I made early on, I was trading what I believed, not what I was seeing happening. I was believing something different was going to happen, but I wasn't in tune. And so that's what technical analysis does for me. It gets me in tune with what's actually happening. Sure, there's going to be changes to that, but it allows you to change quicker than waiting for the next quarterly earnings report and being stuck holding the bag for 3 months or however long. And by that point, it's too late and you're already in the hole and now you're truly stuck and going, now what do I do? What's my repair strategy? Not a fan of repair strategies. I want to close out losers, move on to the next one, and roll from there.
That's great. Can you talk a little bit about your routines? Is there a set approach, a set discipline, whether it's every day, every week or something? How do you orient yourself to what's going on around you? How do you follow the markets? Is there a set sequence that you tend to follow, or is it a little more soft and fluffy depending on where the market leads you? How do you sort of approach the market analysis, the repetition of it?
Well, the big part for me is making it systematic so that we're looking at buy and sell arrows on a chart. We're not saying, oh, it looks like it's breaking out, so I'm going to trade it. It has to have that buy arrow with my system saying, now you get in. If you think it's happening but it hasn't done that yet, you wait because it might. That breakout might be a fake out, right? So you don't want to get caught right at that wrong turning point trying to get ahead of everyone else when in fact you might just be catching it right at the top. So it's one of those where we're looking for a lot of confirmation and validation, and I always say that I'm never going to catch the exact bottom or the exact top. If I get in that game, I'm going to get in a lot of trouble. I'm trying to catch the sweet spot in the middle, and that's the nature of technical analysis and trend following, is that get a piece in the middle is a lot easier trade, a lot less stressful, a lot more consistent and persistent. And so, when you look at like a name like Apple, which is leading the Dow, leading the markets up, and people say, how can this be? And it's like, you just you keep following it while it's doing it. We don't try to do that right in front of the earnings, but I love how I'm a big believer when it comes to the actual fundamentals that earnings surprises are really the driving factor that we do keep an eye on. So we want to watch not just what the news was, that they beat estimates. If they beat estimates and the stock dropped, I grade that negatively. Because that's a negative reaction to what should be good news. And it's like, well, if can't rely on good news, what's going to happen when bad news starts to roll in, right? So if it's bad news and it starts to rally after those earnings, I think that's a great thing. So I'm looking for that reaction because it tells me that, let's face it, the institutions are the ones driving the market. And so I want to be in tune with, okay, do they want more of this stock or do they want to get rid of this stock? So you can see that not just in front of earnings, but actually after the earnings in terms of who was caught flat-footed, how much that stock is kind of persistently going up after those earnings or down. And so you can fall in the same direction as that gap usually. I mean, if it gaps up and then it immediately starts to fail, that's a problem. But if it gaps up and then it continues over subsequent sessions, you know that you've got something that you want to be looking for those buying opportunities. And I teach people a lot about not just chasing every breakout, but also looking for what I call retests, which are buy the dip opportunities once you've gotten that established trend. So there's some very specific rules I have where you can put on a fairly low risk trade. If it stops you out, you're going to get stopped out quickly. If you catch it right, it's going to end up snapping back real quickly and you've gotten a great entry point. So it's one of those where you don't have to have a high win percentage on those if you're stopping yourself out quickly and then letting your winners run. So again, it's that very hard thing for a lot of people to get used to, but just learning that, hey, if I'm not right away, it's usually probably not one of my best ideas. My best ideas are right from the start. I'd submit that most everybody watching is saying, trading is easy when they're right from the start. It's hard when you're fighting and going, well, I want the market to wake up to what I thought was going to happen. And so you got to get out of that view and say, let's get in tune with what the market and the stock is actually doing.
Got it. So you've been running Big Trends for 20 years this year.
Yes.
Congratulations again. Can you talk a little bit about market structure, which has changed dramatically? I mean, that's decimalization, it's bid-ask spreads coming in, it's options market becoming more accessible to individuals. I mean, how has that change in the structure of the market changed your approach or changed your discipline of looking at the markets? Has it done it meaningfully, or are you still doing the same sort of thing you would have been doing at the beginning?
I think we're doing things a little differently in that when I launched in '99, Big Trends, everybody's talking about day trading as a secret to wealth. I'm going, hold on a second. Like, I've made my money by writing these things for multiple days, multiple weeks that were still like a little bit longer swing trades.
Okay.
And that's how I launched Big Trends with my profits that I had traded from over the prior year or two. Yep. But basically one of those things where now our window has compressed because of the technology. Everybody's got the same information, so those trends are not lasting as long as they normally used to. Some do, but most of them are much more compressed.
Okay.
So we might be in a trade 2 or 3 days that might have been a 2 or 3 week trade back in '99 or 2000. So it's I think that because everybody's got this access and you got that point and click ability to get in, get out that much more rapidly. It's not like most people back then would be like, I'm going to read a paper the next day of what happened, and then I'm going to think about it for a day or two, and then decide what I'm going to do. And so you've got this longer window that might be slower but more elongated versus now it's like everybody wanting in or everybody wanting out. But it still can be that pile-on effect where the trend does happen just in a shorter time frame. So I still say big trends exist even on a 15-minute or a 30-minute chart over the next few days and say, okay, so we'll ride, for example, the FANG stocks. We've got a FANG options trader program that loves to trade those just for those next 2 or 3 day windows because they move so well, and when we're wrong, we stop them out quickly. Just buying an in-the-money option or something that's going to give us that stock substitute, and then knowing we're not going to be hanging around very long, and so then you just use a shorter-term vehicle because you know you're not going to be in for more than 3 days. Use a weekly option that might last 7 to 10 days, and then we're in and out in a few and moving on to the next. So I have definitely taken the Big Trends philosophy, but compressed it. But I'm not a day trader. I definitely think that that's still a tough game against what's happening on an intraday basis on the floor that might have better information. But a lot of people worry about high frequency trading, and I'd say that that's going to actually create some more opportunities if you know what you're looking for. So like on a super long-term monthly chart on what I teach, the 87 crash was just a bullish retest, and even you can look back at the 29 crash as a bullish retest until it broke down in the next year, 12 months later in the fall of 1930. That's when the other side kicked in bearishly. But so it's one of those things where you want to watch in both a micro and a macro view of what's happening. So a lot of people just in a presentation here at the expo where people are saying, oh, the market's totally random, you can't predict anything, and I would hardly disagree to say you got these really great long-term and shorter-term charts, and I'd say the longer-term charts are the most predictable. So when you get into like we've had this 10+ year bull market, and it's been very much predictable, especially after about late '09 to early 2010, so that even like the flash crash that happened there that next year, and then that one in 2015, that those were bull retests on a long-term chart that were gifts if you knew what you were looking for and not in that panic mode that everybody was in that moment. So I think if you know what you're looking for, you use that high frequency stuff for your opportunity to kind of buy the dip.
That's great. We need to wrap up. I'd love to talk just a little bit about the current market environment. We're at the situation with the S&P going to new highs again this week, and a lot of questions about leadership and what's leading, what's lagging. Defensive stocks like utilities, real estate have been leading. They're kind of rolling over. Semiconductors ripping. What are you seeing right now here mid-November? I mean, what are you seeing broadly with the equity markets at this point?
Yeah, we were saying in early October that you wanted to be ready to buy every dip because we're coming out of this 6-month sort of choppy phase and moving into the really positive seasonality November 1st through April 30th. And you're seeing that the market is being very resilient. Even earlier today, Dow was down, managed to finish just back up ever so slightly, even though they were saying, oh, maybe the China thing was off, or the president said, and hadn't been fully authorized or approved yet after yesterday saying it was headed in the right direction. That kind of noise is the kind of thing you want to be ready to take advantage of. So I'm bullish because I think in looking out not just on the seasonality, but on the fact that we've had the IPO correction of a lot of the unicorns and the money losers that have been either getting flushed out once they got public or being forced to go back to the sidelines like we work,
Yeah.
that's actually good because the market is kind of correcting that little bit of excess that was happening in the IPO front. It's not like 99 and 2000 where everything under the sun's coming out with this big losses and just like, it's all about eyeballs, it's not about earnings. It's like, no, it really is about earnings. And so it's really about, okay, can they, and even with WeWork, they're saying it has to be self-sustaining, so they're cutting everything back to get back to their true original core vision of just doing what they were supposed to do on the office space leasing. So, it's like, okay, that's an internal correction that's happened. And a lot of people say, well, this market's too narrow, it's just being driven by the FANG stocks and the top big cap names. But there's plenty of opportunity within those names, and also what it leads to is that we can trade the downside on a lot of the other names that are underperforming. So I like that sort of bifurcation where everything's not going up or going down at the same time. I want to be able to trade some bull positions and some bear positions and benefit from that hedge, if you will, buying leaders and selling laggards.
Yeah.
So I am net bullish into next year, but I think in an election year, it'll probably have a lot of chop to it. So you have to not get too hung up on the day-to-day and be ready to buy the dips and sell the rips.
Focus on the big trends, for example.
Absolutely.
Price, this is such a pleasure.
Thank
Good
you,
to see you
David.
again.
It's
Thanks
a pleasure.
for sitting down with us.
I appreciate it. Thank
Folks,
you.
This is Price Headley from Big Trends here at the Traders Expo in Las Vegas.